Prices will continue to decline over the next few months, but we are very close to the bottom. Then we'll stabilize a little bit and start going up. This market will be more balanced. People will not be panicking to sell or to buy. So there is more room to go downward in the next few months. Then we'll stabilize and then we'll go up. But again, expect something much more modest.
In this video, I'm going to give you another broad overview of what's happening in the market, what to expect, and also let you know where there will be deals and how to find them. All right, so let's jump right into it. First, we need to talk about exact market conditions, what's happening, what to expect if you're an investor or if you're just an end user, like you're looking to buy a place, sell a place, make an actual move of your primary residence. Recently, CIBC did an amazing webinar that I attended with Benjamin Tal. He is their chief economist, and he is absolutely on the ball every time I see him speak. And namely, I want to talk about three things that he spoke about in this webinar. Number one, of course, is inflation.
Although everybody is talking about inflation, this, at the end of the day, is not about inflation. This is about the cost of bringing inflation down to target, which is 2%.
Number two, of course, is the labor market, which affects interest rates and how high we can raise interest rates.
And every time that it happens, we look at two things: wages and vacancy rates. We have roughly 1 million vacancies in the economy.
Interest rates in general, and then of course, how interest rates are affecting the housing market and house pricing. And before I get to Benjamin Tal, I want to first discuss a little bit about a video that I just put out a few days ago. I had a lot of people ask me about it. It was an interview that I did with Constantine, and we were talking about foreclosures and where you can find those amazing deals. I want to clarify a point that he had mentioned in there because it is something that I was asked about a lot, and people seem to have misunderstood exactly what we were speaking about.
I shouldn't say a lot. There's a number of MICs that are very prominent in the lending community and that are very often used, who have a policy that on renewal, when you lend, let's say, a second mortgage up to 80% loan to value, on renewal, you have to get an appraisal so you can confirm your equity position so that you know that the risk tolerance for your MIC is appropriate. Here's a problem. If you refinance your property at the beginning of 2022 and you captured your value at the very peak of that, of the values in 2022, the renewal terms may not be available to you because the appraisal might confirm negative equity. And if that happens, I do anticipate a lot of lenders will just call their loans and those properties will land on the market.
When foreclosures happen, or in Ontario, we refer to them as power of sale, when a property is forced onto a market by a lender because someone is in default for their mortgage payments, this is going to happen, and it is already happening. In fact, I am personally representing a few different private lenders that are asking me to put up some properties for sale that are in default. But what Constantine was talking about was a lot of mortgage investment corporations that do a lot of second mortgages. Now, typically these private lenders will do second mortgages on a 1-year term, meaning that if somebody got a second mortgage on a 1-year term back at the peak of the market in Q1 of 2022, the maturity date of that particular mortgage is going to happen in Q1 of 2023. Now, of course, values are extremely suppressed right now. So when those maturity dates come due in the next couple of months, the appraisals that are done on those properties are going to show the value of the home being less than the total debt on the home. And that's when we're going to see big problems because some of those MICs will force those properties onto the market. Now, keep in mind, that doesn't happen quickly. That can take 6 months, sometimes 12 months for that to happen. It is a court process and a lengthy one. And can they be good deals? Yes, they absolutely can. But if you are an end user and you're waiting for these foreclosures to come up because you think you're going to get an amazing deal and it's going to work out for you, I just want to temper expectations. These properties are normally really good deals for investors because there is such a small percentage of the total inventory that is going to be comprised of these particular sales. We're talking primarily about properties that have more than one mortgage on them and that actually happened, or those mortgages commenced at Q1 of 2022. So we're talking about a very, very small number of these properties. And when you're looking at the total grand scope of the inventory that's available on the market, if you're an end user and you're actually looking for a property for yourself, it's very highly unlikely that one of these types of properties are going to check the boxes for you. However, if you're an investor, these could be an amazing deal for you in terms of being able to negotiate based on the loan to value ratio of what the second mortgage place lender is willing to take off if they are in default and have pushed it onto the market. How much is that second lender prepared to lose in terms of the loan? Now, if you have any questions about that, because it was extremely complicated and I moved through it pretty quickly, feel free to just shoot me an email or click the link in the description below. That'll connect you to a calendar where you can book a quick 15-minute chat with me at a time that is most convenient for you. Okay, now that we're done that, let's go into what Benjamin Tal had spoken about in this amazing webinar. But quick, before we do, subscribe to the channel if you are enjoying this content and you find value in it. We'd love to have you a part of our community. And don't forget to hit that like button so this video can be pushed out to more people like yourself. Okay, so first things first, let's hear what Benjamin Tal has to say on the topic of inflation.
So with this shift, higher supply, lower demand, Ben, what do you expect for inflation in 2023?
Yes, that's a good question. And of course, the most important one, inflation. So first of all, we have to establish one thing. Although everybody is talking about inflation, this, at the end of the day, is not about inflation. This is about the cost of bringing inflation down to target, which is 2%. The Bank of Canada, the Fed, the ECB in Europe, over the past 20, 30 years, established their reputation as inflation fighters. They're not going to toss it away. So you give the Bank of Canada two options. One is inflation expectations rising. The other is a recession. They will take a recession any day. And that's why they went by 425 basis points today, to make sure that inflation is under control. So it's not about inflation. It's about the cost of bringing inflation down to 2%. Now, at any point in time, as you said, there are actually three sources of inflation. There is supply-driven inflation, demand-driven inflation, and we don't know driven inflation, which is somewhere in between. The good news is that supply-driven inflation, as you can see in the chart in front of you, is going down. Supply chain is improving. That's significant. You look at the shipping costs down dramatically. You look at the shipping activity back to semi-normal. You look at the situation in the US. Today in the US, listen to this, 20% more truck drivers relative to pre-pandemic numbers. This is significant. Now, why is it important? You can see that it's improving because with every centimeter decline in this chart, the ability of the Bank of Canada to deal with this situation is enhanced. Why? Because if all the inflation that we are seeing is coming from outside, supply chain, Russia, China, the Bank of Canada cannot do anything about it. The Bank of Canada can raise interest rates. That will not impact Putin. But if the contribution of supply is going down, it means that the inflation is more domestically driven, and the Bank of Canada can do something about it. So it's enhancing the ability of the Bank of Canada to deal with the situation. So the good news, the move from 7% to 4% will be like that. It will be very, very quick because commodity prices going down, supply chain is improving. The trick will be to move from 4% to 2%. That's service inflation, and that's where the job market enters the story.
All right, so it looks like we have a long way to go to tame inflation, but we are on our way. It's not going to be an easy fight, but we are definitely going to get there. And that last 2% of inflation that would take us back down to target, so moving from 4 to 2% of total CPI, is going to affect the labor market. So let's hear what he has to say about the labor market.
How concerned should Canadians be about their own personal job security?
Yes, the job market. As you all know, every first Friday of the month at 8:30 in the morning, we get the inflation numbers and, of course, the job numbers from Stats Canada. So at every first Friday of the month, 8:29 in the morning, every economist is sitting in front of his computer looking, waiting, anticipating the numbers. Believe me, it's very exciting. And every time that it happens, we look at two things, wages and vacancy rates. We have roughly 1 million vacancies in the economy, and wages are starting to rise. So it's all about the labor market and to what extent we are going to see a significant increase in wage inflation. And this labor market is changing in a very significant way. In many ways, I'm asking myself all the time, to what extent COVID is an event or a condition? And I believe that maybe medically speaking, it's an event, let's pray. But at the same time, I think that economically speaking, COVID accelerated a lot of trends that we have seen before the pandemic, and therefore, to an extent, it is a condition. The labor market is a good example. I'll give you one point to consider. Look at this. We created roughly 600,000 new jobs since the beginning of COVID, up and down 600,000. Basically all of them, basically 100% of them, university-educated individuals. That's amazing. I believe that COVID opened up the market for educated people. In the past, we had a mismatch in the labor market. We had people without jobs and jobs without people, university-educated individuals with skills serving coffee. This is not the case now, because if they cannot find a job, let's say in Toronto, they can find it in Alberta, BC, in the East, New York, Zooming. So COVID opened up the labor market for educated people. That's very, very significant, a structural change. Overall, we have 1 million vacancies, and I believe this number will go down as the economy slows down, but will buffer the pain and will provide the Bank of Canada the option not to continue to raise interest rates. This consumer still is relatively strong, sitting at roughly $300 billion of excess savings. And if you account for inflation, it's still positive, which means that there is another buffer here. Therefore, our call is for a wannabe recession, not a real recession.
All right, now that we've touched on the two major things that the Bank of Canada looks at when they consider raising interest rates, let's hear the question on everyone's mind. Have we peaked on interest rates for now?
Have interest rates peaked? Are we done? Where are they headed in 2023?
Well, that's the question. The Bank of Canada is telling us, listen, we are done unless something bad happens. So they are keeping the option to continue to raise interest rates, but they would like to stop at this point. Why? Because the damage in the economy is there. The economy is slowing down. We all know that the housing market is slowing down very quickly. And we know that the magic of interest rate is working with a lag. So you know that you will get more damage over the next 6 months. The Bank of Canada knows that. They would like to avoid overshooting. And therefore, our call is that the Bank of Canada is done for now, and they will keep interest rates basically for the entire year at 4.5%. Basically, usually the gap between the last hike and the first easing move is very short. Not this time. Why? Because the Bank of Canada and the Fed would like to make sure that inflation is dead before they cut interest rates. They don't want to repeat past mistakes in which we have seen in the past where monetary policy was eased prematurely. You want to wait, make sure that inflation is dead, and then start cutting. So we expect the first cut to be early 2024. A full year from now.
Ben, should we expect interest rates to be higher than in the past? Do we need to get used to this level?
The short answer is yes. We have a very interesting situation to deal with at this point. We started this madness at a 175 overnight rate. We are going to 4.5, and we stay there for a full year, and then we cut. We cut to what? I said to about 3%. Almost double the rate we have seen before the crisis. Why? Because there are a lot of inflationary forces cooking in the background. We know that inflation was low for a few decades because of few factors. One of them was globalization. The other one was just-in-time inventory. The third was a very forgiving and giving and cheap labor market. Now everything is upside down. We have deglobalization. We have just-in-case inventory. And we have a situation in which the labor market is not very giving and clearly expensive and tight. In addition, we have green initiatives that are inflationary. All those forces are beneath pushing. The Bank of Canada is not going to change the target. We can discuss to what extent they should until we are blue in the face. It will not happen. It's an academic discussion. They are going to keep this target of inflation at 2%. So the target is the same. The forces are stronger. Clearly, interest rates have to be higher than they used to be in order to keep that target. Therefore, we see interest rates stabilizing at about 3%. Now, this is a good thing because cash was mispriced for a long period of time, created some bubbles in the economy, including the bond market. Now we are going back to semi-normal. And let me remind you that this economy can function, this housing market can function very nicely at a 3% overnight rate if you stabilize and get used to it.
And now for the final question, which I think he absolutely nails, is the housing market going to fail and prices crash, Or are we going to see a flat line? What is going to happen with house prices?
When it comes to the Canadian housing market, where do we go from here? Crash, recovery, or flatline?
Well, that's a good one, of course. The housing market is everywhere, so we have to discuss it. And first of all, we have to start with COVID. We all know that prices went up by 46% in 2 years. 46% in 2 years. Madness. Now, why it happened? It happened because of the asymmetrical nature of this crisis. All the jobs, basically all the jobs that were lost, were low-paying jobs, young people, renters. And that's why, by the way, rent went actually down during COVID. Home buyers, potential home buyers, during COVID, their job was there, their position was there, their income was there, and interest rates were in the basement. So the best way to understand the housing market during COVID is to say that home buyers during COVID got the benefit of a recession through extremely low interest rates without the cost of a recession vis-a-vis a broadly based increase in the unemployment rate. We have never seen anything like that. There was a sense of urgency to get into the market. And parents, by the way, told their kids, you know what? You get into the market, we will help you. Gifting reached a record high during COVID. So if there is a sense of urgency, people were front-loading activity. They were borrowing activity from the future. And the future has arrived. We are in the future. Now, this is not a meltdown. This is not a crash. This is reallocation of activity over time. And this market is now slowing, and that's a very healthy situation. This is not a crash by any stretch of the imagination. And I think that will continue. And what's interesting in this cycle is the fact that supply listings still down. Usually, when you have a correction in the housing market, listings go up. That's not the case now. People are not selling. They are waiting. And that's protecting prices from going down even further. I think that will change in 2023. We will see more listings, and that's why I see that the downward pressure on prices will continue over the next few months until they stabilize. But from a long-term perspective, this is not a weak market by any stretch of the imagination. In fact, the opposite is the case. It's getting tighter. Why? Because we still get the demand. I estimate that in 2022, we got no less, listen to this, no less than 950,000 newcomers into Canada. Almost 1 million people in 1 year. This is new immigrants, non-permanent residents, foreign students, and people from the Ukraine. That will continue in 2023. None of them is carrying their house on their back. So you have a situation in which the demand is there. Now, what's happening to supply? We are not building. Developers are telling us things are too expensive, we cannot build. In Toronto, we estimate that 1/3 of new buildings not going. They basically were canceled or postponed. So the supply 2 years from now will not be there. The demand is definitely there. You don't have to be an economist to predict what will happen. So the fundamentals from a long-term perspective are still very strong as far as prices are concerned, unfortunately, because that's not a good thing. And short-term, the market will slow down. We need to provide more supply into this market to bring it back to normal conditions. We have a situation in which, again, you go back to 2008, the US went through the mother of all deleveraging. Their debt to income ratio actually went down. Ours went up because, again, it was not our recession. So when you have more debt, you are more sensitive to higher interest rates. In addition, in the US, there are 30 years mortgages, we have 5. Therefore, again, we are more sensitive to higher interest rates. I estimate that 1% increase by the Bank of Canada in terms of interest rates is equivalent to 2% increase by the Fed. So what I'm telling you here is that the tiny Bank of Canada is more powerful than the mighty Fed when it comes to monetary policy effectiveness. In addition, not only is the Bank of Canada more effective against the Fed, it's more effective against itself. What I mean by that, you go back to 1987, 1990. Interest rates went up by 650 basis points. That led to the 91 recession. Today, we are 425, so 650 is more than 425. However, if you adjust the 650 back then to today's debt level, it's actually only 300 basis points. So today's increase in interest rates is more powerful than what we have seen between 1987 and 1990 that led to the 91 recession. That's why we hope and pray that the Bank of Canada will stop. We have to remind ourselves that every economic recession over the past few decades was helped, if not caused, by a monetary policy error. You want to make sure that you are not overshooting. I think prices will continue to decline over the next few months, but we are very close to the bottom. Then we'll stabilize a little bit and start going up. I don't see prices rising the way they did during COVID or even before COVID, because I think there is a limit to how much prices can rise. I think that they are still expensive. Remember, during COVID, 46%. We are down by only 12, 13% if you measure it correctly. So there is more room to go downward in the next few months. Then we'll stabilize and then we'll go up. But again, expect something much more modest than in the past. This market will be more balanced. People will not be panicking to sell or to buy, and that's a good thing.
So there you have it. That's what Benjamin Tal thinks is going to be happening with the market moving forward. But I'd love to hear your thoughts. So please feel free to comment down below. Let me know what you think. Is he way off the mark? Do you think we are going to hit doomsday and everything is going to crash? Or are you more optimistic about the future of the Canadian housing market? Thanks so much for tuning in again, and I'll see you next time. If you like that video, click the subscribe button on the right, or feel free to enjoy another video here on the left.